Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down a company that it really operates as the central nervous system for the entire property and casualty insurance industry. We're talking about Verisk Analytics. On the surface, it looks like a standard data company, but here is the setup. You have a business with what is, for all intents and purposes, a literal monopoly on data. You've got margins over 50%, and it's currently sitting in the bargain bin after, a 19% correction. The market is basically screaming that growth is dead. But the real question for us is this. Is this a value trap, a melting ice cube? Or is the market completely mispricing a cash flow cannibal that is about to eat its own float? That's what we're here to find out.
That's a huge topic and a really important one. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time. Really helps us out.
And while you're there, please like, subscribe, and let us know your questions in the comments. We do read them.
Now, let's get into it. Pillar number 1, the business model. To really understand whether Verisk is a trap or, a treasure, we have to look under the hood at what we call the black box.
Okay, let's unpack this black box concept because it is the fundamental engine of the entire company. And frankly, it's a business model that almost feels like it shouldn't be legal because it is so incredibly advantageous.
It's an amazing setup. So Verisk operates on what they call a give-to-get model.
Okay.
It's actually pretty simple in its brilliance.
So if I'm an insurance company, let's say I'm selling car insurance or home insurance, I'm dealing with risk all day long. But I can't price that risk in a vacuum. I need to know the probability of a house burning down or a car getting into an accident in a specific zip code.
Exactly. And to get that probability, you need data. A lot of it. And this is the key part. It can't just be your own data. Unless you are an absolute behemoth, like one of the top 2 or 3, your own sample size is it's too small to be statistically significant.
Can you give us an example of that?
Sure. Let's say you're a mid-sized insurer in Ohio. You might insure 10,000 homes. Now, if none of them burned down last year, does that mean the risk of fire in Ohio is 0?
Of course not. It just means you got lucky.
You got lucky, but you can't price your policies based on luck. You would go broke. You need the industry's data, everyone's data, to understand the true underlying frequency of fires or floods or anything else.
So enter Verisk. They manage this thing called the ISO database. And here's the deal, right? The insurers provide their raw claims data to Verisk. They hand over all their internal numbers, their losses, their premiums, their claims history.
All the secret sauce, they pour it into this central repository. In return for giving that data, they then have to pay a subscription fee to get access to the aggregated analytics, the actuarial tables, and all the fraud detection tools that Verisk builds from that collective pool.
It's a cooperative pool, basically.
That's a perfect way to put it. Think of it like a potluck dinner, where the ticket to entry is bringing a dish. You can't show up and eat. You have to contribute your casserole.
Yeah.
But Verisk is the organizer who takes everyone's dishes, mixes them into a perfect buffet, ensures nobody poisoned the potato salad, and then they charge you an entry fee to eat the food you help provide.
It sounds kind of audacious when you put it like that. It's like a racket. But I get why it has to exist. It's really the only way for the smaller and mid-sized guys to get a clear picture of reality.
Precisely. It solves a market failure. And for investors, the revenue structure that comes out of this is just beautiful. It's a recurring subscription model. This isn't a one-time transaction where Verisk sells a report and walks away.
No, these insurers are completely hooked into the system.
They are. The retention rates are incredibly high. We're talking high 90s because, frankly, their business stops functioning without this data. If you're an underwriter and your boss tells you the Verisk fee is being cut off tomorrow, you're suddenly just guessing. And in insurance, guessing is a very quick path to bankruptcy.
Okay, so that leads us directly to the moat. In our framework, we're always looking for a cornered resource, something that is scarce, valuable, and cannot be easily replicated. For Verisk, that resource is the ISO database itself.
And this is where it gets really, really interesting from an investment standpoint. We aren't just talking about a database of last year's claims. That would be valuable, sure. But we are talking about decades of historical claims data.
Why does that history matter so much? I mean, in a world of AI and big data, why can't a startup just scrape the web, build a better model, and compete?
Because that history is the entire game. A competitor could come along with better technology, They could have faster servers, a more advanced AI, a slicker user interface, whatever. But they face a physical and legal impossibility. They cannot force insurers to hand over 20 years of past claims data. That history is locked inside Verisk.
It's like trying to build a time machine. You can't just invent historical data points.
You can't.
Yeah.
That's it. If I'm an insurer and I'm trying to price a policy for a 100-year flood event, or I'm trying to model these really long-tail liabilities like asbestos claims or environmental lawsuits.
Things that take decades to play out.
Exactly. I need data that goes back far enough to capture those long, weird cycles. A startup with 2 years of data is totally useless to me. It's just noise. Verisk has the signal because they have the timeline.
So the barrier to entry isn't about code, it's about time. You physically have to wait 20 or 30 years to replicate what they already have today.
Precisely. And by then, they'll be 50 years ahead. And then on top of that, you have the scale economies. The cost for Verisk to collect and normalize all this messy data from hundreds of insurers. That's a fixed cost. It costs them a certain amount to run the servers and pay the data scientists.
But the cost to sell that resulting insight to the next insurer?
It's effectively zero. The marginal cost of distribution is nil. It's pure profit. And that is why their margins are so high, which we will definitely get to later.
I want to touch on the mental models here because this is a classic Lollapalooza effect, to borrow a term from Charlie Munger. You have multiple psychological and economic forces all pushing in the same direction, making the moat even stronger.
You absolutely do. Let's start with social proof. If you are a small or mid-sized insurer and every single one of your competitors is using Verisk data to price their risk, you absolutely have to use it too.
Because if you don't, you face adverse selection.
You get creamed by adverse selection.
Let's define that for the listeners. That's the idea that if you are the only one at the poker table who doesn't know who the sharks are, you are the sucker, right?
That's basically it. Let's make it more concrete for insurance. Imagine everyone else in the market knows that a certain zip code has an unusually high risk of hail damage because they have the Verisk data showing decades of claim history.
Okay.
They will all raise their prices for homeowners insurance in that area to cover the expected risk. Now, if you don't have that data, you might keep your prices low because, from your limited viewpoint, it looks like a perfectly safe neighborhood.
And suddenly all the high-risk customers flock to you because you're the cheapest option on the block.
You get all the bad risk. A big hailstorm hits, you have to pay out a mountain of claims you weren't prepared for, and you go bust. So you are forced to subscribe to Verisk, not to get an edge, but just to survive.
It's defensive spending. You're not buying it to get ahead. You're buying it to keep from drowning. It's the cost of doing business.
It's the cost of staying in the game. And then you layer on the switching costs. This isn't just a simple login on a website. Verisk's data feeds, their software, their tools, they're integrated deep into the underwriting workflows of these companies. It's part of the plumbing.
To rip it out would mean re-engineering your whole process.
A nightmare. And there's an element of authority bias here too, which is huge.
How so?
The ISO database isn't just a database. It is the authority. State insurance regulators often look to ISO data as the benchmark. If an insurer wants to file for a rate increase with the state insurance commissioner saying, our request is based on the latest ISO loss costs, that just greases the wheels. It gives them regulatory cover.
So if you are an insurance executive, using Verisk isn't just about getting good data, it's about regulatory survival and maybe career survival too.
You've nailed it. It's about not getting fired. I used the industry standard. It's a fantastic defense in a courtroom or in a board meeting when something goes wrong.
It creates a liability issue if you don't use it.
A huge one. It becomes the standard of care. If an insurer stops using Verisk and then blows up because of bad underwriting, the shareholders will sue the management for gross negligence.
Yeah.
The first question in the deposition will be, why didn't you use the industry standard data that everyone else uses? It's a very, very powerful defensive position for them.
Okay, now, we have to play devil's advocate here. We always check for the anti-moat. The obvious question is, why do the insurers put up with this? It sounds like they're being held hostage. Why don't they just form a consortium, put all the data on a blockchain or some shared server, and cut out the middleman?
That is the multi-billion-dollar question.
Yeah.
And it comes down to the collective action problem. It's the same reason we have governments or, trade unions. It's incredibly hard to get a group of fierce competitors to cooperate.
They just don't trust each other.
Not at all. State Farm doesn't trust Allstate. Allstate doesn't trust Liberty Mutual. They are at war with each other for market share every single day. If they tried to build a shared database themselves, they would constantly suspect the others of scrubbing their data or holding back the secret sauce or trying to get a peek at their confidential information.
So they need a neutral third party to sit in the middle.
Exactly. They need Switzerland. Verisk is the neutral arbiter that everyone trusts, or at least has agreed to trust, to sanitize and aggregate the data fairly. That trust is hard-won over decades, and it's even harder to replace. You can't just code trust into a smart contract overnight. Someone has to verify the inputs are real and fair. Verisk is that verifier.
Okay, so the business engine is incredibly robust. It's a toll booth on a critical highway for the insurance industry. But let's look at the numbers. Let's move to pillar number 2, financial resilience and the quality test.
Right. This is where the rubber meets the road. We can tell these great stories about moats all day, but do they actually show up in the financial statements?
So do they.
For Verisk, the answer is a resounding yes. Let's just start with the margins. Adjusted EBITDA margins are currently expanding, and they're hitting around 54.7%.
55%. That's not just good, that's elite software company territory. That is better than most software territory.
It is, and it directly confirms the scale economies we just talked about. Their revenue growth is outpacing their cost growth. Every new dollar of revenue has very, very little cost attached to it, so it flows straight to the bottom line.
Yeah.
But as rigorous analysts, we have to check the quality of those earnings.
You mean we have to talk about stock-based compensation or SBC?
We have to. It's the silent killer of shareholder value, especially in tech and data companies. We see it all the time. A company claims to be highly profitable, but then you find out they are paying their employees with millions of newly printed shares of stock, diluting the actual owners.
So the reported profit is a mirage.
It can be. So we did the reality check on Verisk. Their annual SBC runs about $135 million. Now, that sounds like a lot of money, but you have to compare it to their free cash flow.
Which is what?
Which is roughly $850 million a year. So that means SBC is about 16% of their cash flow.
16%. So how should we think about that? Is that good or bad?
I'd call it acceptable. It's not perfect, but it's not egregious. In the tech world, we frequently see SBC running at 30, 40, even 50% of revenue for some of these high-growth companies. At 16% of FCF, Verisk is managing it responsibly. The free cash flow yield we are seeing is real cash. It's not an accounting fiction created by printing stock certificates.
Good. So the earnings are real. Now, what do they do with all that cash? This brings us to capital allocation and what you call the Cannibal strategy.
This is my favorite part of the Verisk story because it shows management is aligned with shareholders. They are a cannibal. They consistently, relentlessly eat their own stock.
How much are we talking?
The share count dropped by about 3% in 2024 alone, and it has been going down consistently for the last 5 years, a core part of their strategy.
And the context here is critical. The stock has crashed down to around $179. If they were buying back stock at $240, that's fine, it's value accretive. But buying back that same stock at $179, that is just high-octane fuel for per-share value growth.
Precisely. Let's really break down the math of why a low stock price is actually a gift for a shareholder of a cannibalistic company. Imagine the company is a pizza, and it's cut into 100 slices. You own one slice, so you own 1% of the company.
Okay, I'm with you. I own one slice of the Verisk pizza.
The company has a great year. They generate a big pile of cash. Now, instead of giving you a dividend, which would be like putting an extra piece of pepperoni on your slice, they go into the open market. And because the stock price is low, that pile of cash can buy back, let's say, 10 slices from other people. If the stock price were high, that same cash might have only bought 5 slices.
Got it. More bang for their buck.
Way more. So they take those 10 slices they just bought, and they metaphorically throw them in the trash. They retire them.
So now there are only 90 slices of pizza left in the world.
Exactly. You still only hold your one original slice. You didn't do anything. You didn't spend any money. But now you own 1 out of 90 slices. Your percentage ownership of the entire company just went up automatically. You now own a bigger piece of the future earnings, a bigger piece of all the assets.
And if they do that every single year for 10 years...
Eventually, you own a huge chunk of the pizza without ever buying another slice yourself. And here's the real magic.
Yeah.
Even if the company's total earnings stay exactly the same flat as a pancake, your earnings per share still go up every year because the denominator, the number of shares, is constantly shrinking.
That is the magic of the Cannibal. You don't need explosive top-line growth to generate double-digit returns for shareholders if you are shrinking the share count that effectively.
It's an incredible engine for compounding wealth. And they also made a big strategic move recently by selling Wood Mackenzie. Can you explain the logic there?
Yeah, that was a huge deal. Wood Mackenzie was their energy consulting business. It was a good business, a very famous brand in the oil and gas world, but it had much lower margins and was way more cyclical than the core insurance business.
Right. Oil prices go up, oil prices go down. Exploration budgets get cut when oil is cheap.
Exactly. It polluted this beautiful, steady, recurring revenue model of the insurance business with this lumpy, cyclical, project-based business. By selling it, they effectively pruned the portfolio. They took the cash, cleaned up the balance sheet, and focused the entire company purely on that high-margin recurring revenue insurance data core.
It sounds like a move to optimize for a higher ROIC, return on invested capital.
That's exactly what it was, and it shows. Their ROIC right now is sitting at roughly 18.6%.
And their cost of capital, their WACC, is probably somewhere around 8 or 9% in this environment.
So that spread, the difference between the 18.6% they earn and the 9% it costs them, that's where true economic value is created. It easily passes our quality threshold of 15%. This shows that management isn't just empire building, they are value building.
Okay, so just to recap, we have a fantastic business with a deep moat, sky-high margins, and smart capital allocators at the helm. And yet, the stock is down significantly. So pillar number 3, valuation and the market disconnect. Why is this thing in the bargain bin?
Let's look at the price action. The stock has corrected down to about $179. It's now trading at roughly 23 times forward earnings. Historically, this is a stock that often traded at over 30 times earnings.
The market has definitely re-rated it downward.
It has. And the narrative, the story driving that re-rating seems to be that it's a stalling compounder. Investors are terrified that its organic growth is permanently slowing down to, utility-like speeds, 3%, maybe 4% a year.
That is the core fear. The market hates uncertainty, and it's pricing in a permanent slowdown. But let's do our own work. Let's try to triangulate the intrinsic value and see if that fear is justified.
Okay, what's our first method?
Method A is just simple mean reversion. Let's assume the business is not broken, and it eventually goes back to its 5-year average valuation multiple, which is around 28 times earnings. If we apply that multiple to the 2026 earnings estimate of about $7.84, the implied value is $219.
Okay, so that's a decent upside from 179 right there, just on a return to normal.
It is a very simple path to a solid return. Method B. Let's look at what the sell-side analyst consensus is. The average target out there is around $274. Now, you take that with a grain of salt, but it shows we're not the only ones who think it's worth more.
In Method C, our own model.
All right. Method C is a conservative owner earnings model, a simple DCF. If we just take their current free cash flow of $850 million and grow it at a very modest 6% a year, we get an intrinsic value of about $190.
So every way you slice it, mean reversion, analyst views, our own conservative cash flow model, the stock looks undervalued. The current range, say between 170 and 185, seems to offer a distinct margin of safety.
It absolutely does. And we have to look at the recent numbers on pricing power versus friction. There was some noise about revenue misses, but if you strip it out and look at the core subscription revenue, it grew 10.6% in the first quarter of 2025.
10%. That is double digits. That flies directly in the face of the stalling compounder narrative.
It completely contradicts it. It shows that even if the transaction volume, which is the number of times insurers look up a specific claim or property, fluctuates because the economy is wonky or people are driving less, the core pricing power is holding up beautifully. Insurers are paying more for the subscription itself, even if they use it slightly less in a given quarter. That is the definition of resilience.
Let's reframe this whole valuation discussion for the listener who might be new to this. We threw around a lot of numbers. 23 times earnings, 28 times earnings.
Let's simplify it. Think of it this way. The S&P 500, the average stock in the market, trades at around 20 or 21 times earnings right now. Verisk's trading at 23 times.
So it's carrying a very slight premium to the average company.
Right, but then you have to ask yourself, is Verisk an average company?
Absolutely not. An average company doesn't have a functional monopoly on essential data. An average company doesn't have 55% EBITDA margins. An average company isn't so deeply integrated that its customers can't function without it.
Exactly. So normally you have to pay a massive premium for a business of this quality. You usually have to pay 30, 35, maybe even 40 times earnings. But right now, because of these short-term growth fears, you can essentially buy a Ferrari for the price of a nicely equipped BMW.
That's a great analogy. It's not a junker car. It's a high-performance machine that is currently in the shop for a minor tune-up, and the current owner is panicking and selling it cheap.
And we're the mechanics who have looked under the hood and know that the engine is perfectly sound.
So if we zoom out, what does this look like over the long haul? This brings us to pillar number 4, the 10-year horizon. We like to use what we call the TSR algorithm, total shareholder return.
Right. We try to strip away all the quarterly noise and look at the simple, fundamental equation for shareholder returns. TSR equals organic growth, plus margin expansion, plus buyback yield, plus the dividend.
Okay, let's plug in the numbers for Verisk. Let's start with organic growth.
Organic growth. We feel comfortable modeling this at 6 to 7%. You can think of that as basically GDP growth plus their consistent pricing power. They have price escalators built into most of their multi-year contracts.
Okay, 6 to 7% on the top line. What about margin expansion?
I put this at 0, or very limited upside. They are already at a ceiling of around 57.5% on their adjusted operating margins. It's hard to get much more efficient than that without cutting into bone. So let's be conservative and say that's flat.
Fair enough. Dividend.
The dividend is about a 1% yield right now. Not huge, but it's something.
Okay, so we have roughly 7 to 8% return just from the business operations and the dividend. But now we have to add in the turbocharger, the Cannibal factor.
This is where the math gets really fun and where the real alpha can be generated. If they use, say, 80% of their free cash flow for buybacks at these current low prices, they can retire about 2.7% of the company's outstanding shares every single year.
Let's do the math on that. If you compound that 2.7% reduction over a decade, that means the total share count drops by roughly 25%. 1/4 of the company disappears.
Correct. So think about what that means. Even if the net income of the company, the actual pile of cash they generate, only grows at a modest 6%, your earnings per share, the EPS, will grow at 9 or 10% because your piece of the pie keeps getting bigger as the denominator shrinks.
That is the magic. You don't need explosive top-line growth to get double-digit shareholder returns. The financial engineering of the buyback does the heavy lifting.
And there's also a strategic pivot happening here that could boost that growth rate. They're trying to move from being just a data vendor to becoming a decision engine.
Explain that shift. That sounds a little bit like corporate buzzword bingo.
It does, but I think it's actually significant. From, say, 2015 to 2025, the model was, we have the best data, you pay us to access it. From 2026 to 2036, the model is evolving too. We will run the critical decision logic that is embedded in your automated workflow.
You mean like with touchless claims?
That's the perfect example. Insurers are desperate to automate the entire claims process to save money on expensive human adjusters.
So instead of an adjuster driving out to look at a fender bender, an AI just looks at a photo of the car, references Verisk's parts database, and automatically cuts a check to the body shop.
Exactly. And Verisk wants its tools, like their Xactware platform and their anti-fraud systems, to be the brain of that entire automation. They don't just want to provide a data point. They want to own the arrows in the workflow chart.
And if they pull that off, they become impossible to rip out.
Impossible. You can't fire Verisk without completely breaking your own automation and rehiring thousands of people. That is process power. And it's probably the strongest form of switching costs there is because it involves deep organizational inertia. No chief technology officer wants to undertake that kind of project unless the system is fundamentally broken.
And Verisk's system is not broken. It works very well.
It's the industry standard for a reason.
Okay, this all sounds incredible, but we have to be realistic. We can't just paint a rosy picture. This brings us to pillar number 5, risks, the premortem, and the red team challenge. What could kill this entire thesis?
Right. So let's put on our red team hats. The primary bear case is what we call the utility trap.
The idea being that the market is right, and this is just a boring, slow-growth utility company now.
Exactly. The argument goes like this. You are paying 23 times earnings for a utility. Real utilities, like your power company, usually trade at 15 or maybe 18 times earnings. So if growth really is permanently stuck at only 4%, then the multiple should compress down to that utility level.
And if it goes to 18x earnings, the stock drops to about $140 a share.
That's a painful drop from here. That's the biggest risk. And what about insourcing? We hear all the time about how Geico and Progressive are building their own massive tech stacks.
Right, the giants.
This is a legitimate risk with the biggest players. Companies like Geico and Progressive are so massive that they have their own proprietary data lakes. They have millions and millions of customers and billions of miles of driving data from their telematics devices. They might reasonably decide they don't need the pooled industry data as much as a small regional insurer does.
So if the whales leave the cooperative pool, the pool itself becomes less valuable for everyone else.
Potentially.
Mm.
I think the counterargument is that even the giants still use Verisk for benchmarking. Even if you have your own sophisticated model, you still want to know the industry standard model says. Just tenor check your own math. You don't want to be a massive outlier unless you are really, really sure you're right and everyone else is wrong.
Okay, and we have to talk about the elephant in every room these days. AI, our idiot nephew test. What if a large language model can just scrape a bunch of public data and synthesize its own risk models without needing Verisk's proprietary database?
It's a valid fear, and it's the first question everyone asks. Can't ChatGPT just guess the risk of a house burning down? But this is where the cornered resource Moat comes back to protect them.
How so?
You could use AI to model risk, sure, but at its core, AI hallucinates. AI makes educated guesses based on patterns. What you cannot do is hallucinate 20 years of actual historical paid claims history. That is hard data. It's recorded fact.
AI needs clean training data to work.
Exactly. And Verisk owns the cleanest, deepest, and most valuable training data set in the world for this specific niche. If anything, the rise of AI makes Verisk's proprietary data even more valuable because you need clean, verified, ground truth data to train the models. Garbage in, garbage out. Verisk is the non-garbage input.
What about regulators? Is there a risk there?
That's the final big risk, I think. If regulators ever decide that Verisk is essentially a tax on insurance premiums, that they're using their monopoly power to drive up the cost of insurance for everyday consumers, they could step in and cap their price increases.
And that would crush the growth algorithm we built.
It would kill it. That's a real stroke of the pen risk.
Yeah.
But given how fragmented the insurance market is in the U.S., it's all regulated state by state, it's hard to see a unified federal crackdown happening overnight. It's a tail risk, but it's there.
I want to double back on something we barely touched on. Climate risk. It seems like it could be a massive double-edged sword for this business.
Oh, it's huge. Insurers are, frankly, terrified of climate change. Wildfires in California, hurricanes in Florida, these massive floods in places that have never flooded before.
Yeah.
The old historical models might not be enough to predict future risk anymore.
So wait, doesn't that actually hurt Verisk? If history is their main moat, but history is no longer a good predictor of the future because the climate is changing, doesn't that weaken the moat?
That is the idiot nephew risk again, but let's flip it. Verisk isn't just sitting still and selling 1980s data. They are actively layering sophisticated climate models on top of their historical data. And they have key advantage. They have the underlying property data. They know exactly what a specific roof is made of, the slope of the land it's on, the exact distance to the nearest tree line.
So they can combine the specific physical attributes of a property, which they have in their core database, with these new forward-looking climate models.
Precisely. And because they have that cornered resource of the specific property data for millions of homes and businesses, they are the best positioned in the world to tell you how a new wildfire model applies to one specific house.
So it's another cross-sell opportunity. You already buy our historical loss costs. Now you need to buy our proprietary fireline score to see which of your houses are most likely to burn down next year.
Exactly. That is wallet share expansion. They don't even need new customers. They just need to sell more and more critical modules to their existing captive customer base. Cyber risk is another one.
Cyber insurance feels like the Wild West right now.
It is. No one knows how to price it. And insurers are desperate for data. Verisk is trying to position itself to become the ISO of cyber, collecting data on hacks, breaches, ransomware payouts, all to help insurers price that risk. If they succeed there, that is a massive new revenue stream that the market isn't pricing in at all today.
Okay, wow. We've looked at the good, the bad, and the ugly. I think it's time for the outro and our final verdict.
Let's synthesize all of this. On our quality score, I give it a very high score, an A-. It is a classic toll road business with incredible resilience and pricing power. On valuation, I'd say it's cheap. It's a buy. The quality premium that this stock normally commands is almost completely evaporated.
And if we look at the scenario planning for the next 10 years?
In the bear case, the utility trap scenario, where growth slows to 4% and the multiple compresses, we are looking at a $270 stock in 10 years. That's a CAGR of about 4%. Not great, but you don't lose your shirt. Your capital is preserved.
And the base case, the most likely outcome.
The base case, where they hit 7% organic growth and continue the buybacks. That puts us at about a $576 stock in 10 years. That's a very solid 12.4% annual return.
And the bull case?
The bull case, if this AI-powered decision engine monopoly thesis plays out and the market re-rates it back to a premium multiple, you could see the stock at around $840. That's a 16.7% CAGR.
The asymmetry there is really clear. The market seems to be pricing it much closer to the bear case. If it simply performs as a base case compounder, just doing what it has already been doing for the last 20 years, the returns are well into the double digits.
We aren't betting on a miracle here. We are betting on the status quo at a discount price.
That's pretty much the definition of value investing, isn't it?
It is.
One last thing before we go, we should probably mention the debt load, just to be thorough.
Good catch. We did mention enterprise value, but what about the debt itself?
Net debt is about $3.2 billion. For a company of this size, is that a worry?
Not really. For a business that generates this much stable cash flow, that is very manageable. Their leverage ratio is quite low. They could pay off all of their debt in less than 4 years with just their free cash flow if they really wanted to.
Because the cash just gushes out of this thing.
Right. Now, they won't do that because the debt is cheap and they'd rather use that cash to buy back stock, which is a better use of capital. But the point is the balance sheet is a fortress. This isn't some distressed situation.
It's a distressed price on a fortress business.
That's the perfect way to sum it up.
All right, I think we have truly squeezed all the juice out of this one. We've covered the black box, the moat, the financials, the Cannibal strategy, the valuation disconnect, and the future.
I feel good about it. I think we've covered the key points.
Me too. Listeners, thank you for sticking with us through all the weeds. We really hope this gives you a useful framework to look at Verisk and other quality compounders like it with a sharper, more critical eye.
And as always, please do your own due diligence. This is not investment advice. We are just two analysts talking into microphones.
But we like to think we are pretty good at it. So check the links in the description, smash that like button, and we will catch you on the next deep dive.
Goodbye, everyone.